So do you know what are index funds and what are actively managed mutual funds and what are ETFs and which one should you choose? Well, in this video, I'll discuss how these different investment vehicles came around and evolved over time and which one is the best for you to choose. At the end of the video, I'm going to rank them worst to the best. Hi, I'm Dr. Abhishek Gadre. I'm a practicing pulmonary and critical care physician, and welcome to the Money Matters MD Show. So let's start with what is an index. So index is not an investment itself. Index is just the reference scale. It's like a yardstick against which you monitor or against which you measure the performance of these other investment vehicles. What are investment vehicles? So the mutual funds, actively managed mutual funds, the index funds, the ETFs, and the active ETFs, all these four different types of investments that we'll talk about are considered investment vehicles. That's how I'm going to refer to them in the rest of the video. Now, what is actually an index? Index is a basket of stocks with a common property. So let's talk about the US stock market, and you can represent the US stock market by a 9-box square 3x3, and this style of representing the US stock market is called the Morningstar style boxes. The top 3 boxes, the top row represents the largest size companies rating in the US with the headquarters in the US, and it's represented by the S&P 500 index, which is the largest, most commonly followed index. The second row in the 3x3 squares is the mid-cap companies. These are the medium-sized companies or the mid-cap company index. The bottom tier is the smallest companies listed publicly in the US. These are small cap companies. On the right side, you see more growth companies, kind of like Tesla and Nvidia, which are growing rapidly and investing all the earnings in themselves, and they tend to not pay out as much of a dividend. So you will have an index for every single individual square in this box. You can have an index for large cap growth, you can have an index for entire large cap, or you can have an index for the entirety of the US total stock market. So what are actively managed mutual funds? So let's go back about 100 years. The first actively managed mutual fund came out in 1924. Before that, as you can imagine, all you could buy was individual stocks, and you had to place an order using a telegram, and the stockbroker would go on the New York Stock Exchange trading floor, and they'll have to yell and wave their hands to negotiate the price and then finally buy your stock. As you can imagine, buying an individual stock was a tedious process, and you didn't really have too many options to research these stocks either. So at that time, some smart money managers came along and they said, well, they'll handpick the best stocks for you and they'll put it in a basket and sell it to you, and you can save up on the effort. And they will charge you a mutual fund expense ratio to do this work for you. So this process of handpicking stocks is called a actively managed mutual fund. These money managers promise that they can beat the average investor and the average of the stock market. Now, as you remember, the average of the stock market is represented by an index. So what essentially the actively managed mutual fund is trying to do is beat the index. Well, it turns out in the past 100 years of all the history we have developed in the stock market, we know that 90% of the actively managed mutual funds don't actually beat the corresponding index. Well, and actively managed mutual funds also have a high expense ratio. Historically, they would charge anywhere from 1 to 2% of all the money that you have invested with them as a fee, which is incredibly high. And it has come down over the years because of all the other options that we're going to talk about with the competition, with the index funds and the ETFs, but it's still in the 0.5 to 1% or up to 1.5% even expense ratio category. They're still quite expensive. So next, let's talk about what an index fund is. Now, as I told you, an index fund is a fund which invests in the index. So there was a really smart man called Jack Bogle who established a company called Vanguard back in 1976. And this was based on his thesis from Princeton University. And what he did is he calculated the returns of the actively managed mutual funds compared to the index, and he found that most or the majority of the actively managed mutual funds were not able to actually beat the index. And he said, why don't we start a method to give the public access to invest directly in the index instead of trying to beat the index? He said, try to be the market instead of trying to beat the market. The expense ratios on index funds tend to be extremely cheap. For example, you can buy VTSAX, which is Vanguard Total Stock Market Index Fund, for around 0.04%. That is extremely low. Now, over the past 50 years, since 1976, since Jack Bogle started the first index funds, a lot of fund flows and investments are moving much more towards passively managed index funds, and less of the money is flowing towards actively managed mutual funds, just because they're cheap and you will get 90 percentile performance just to be in the market instead of trying to beat the market. So now let's talk about the third type of investment vehicle called the ETF, which is an exchange traded fund. Now, what problem is an ETF trying to solve? So in 1993, SPY, the Spider S&P 500 ETF, was the first ETF which was introduced in the market. Now, the problem with index funds and mutual funds is you can't freely trade them like an individual stock. For example, for an individual stock, you can buy it at 10 a.m. and you can sell it at 10:05 if you want. And you can short an individual stock, you can leverage an individual stock, you can bet against it or double bet on it. You can even set a particular target price you want to buy it at. What they did is essentially they took a basket of stocks, and which is essentially like a mutual fund, and they wrapped it in a individual stock-like behavior, and these ETFs basically trade freely on the stock market, and you can do all of these things with an ETF. You can short an ETF, you can leverage an ETF, and you can set a target price for an ETF if you want. The ETF wrapper is also the most tax-efficient wrapper, and traditionally most ETFs were based on an index. So they were passively managed and they were just like index funds. And to the point that Vanguard has a lot of these index funds and corresponding ETFs, and it even allows you to switch from its corresponding index fund. You can go from VFIAX, which is the S&P 500 index fund, and you can actually ask them to transition it to VOO, which is a S&P 500 ETF from Vanguard. Now, the fourth category and the latest category of investment vehicles are actively managed ETFs. So this is kind of like a hybrid between an actively managed mutual fund, which is wrapped in an ETF wrapper. And what the ETF wrapper essentially does, it makes it a low expense ratio while the fund manager is still trying to actively buy and sell investment inside this wrapper to try to beat the market. So this is an actively managed ETF. The first actively managed ETF came out in around 2008, and in 2019 they got a lot of different regulatory approvals, and it really made the ETF basket flexible, and they could basically put whatever they wanted inside an ETF wrapper. And actively managed ETFs have just blown up over the last few years. So competition is always good for the consumer. It's always good to have more options and more companies trying to compete with each other. And in the past, it was just, one option of actively managed mutual funds. And now, because of all these index funds and ETFs, the expense ratios have come down so darn low. As I said, the Vanguard ETF for VTI is about 0.03%. Now, there's another example, actually. So Fidelity a few years ago launched a 0% expense fee mutual fund. And it's a passively managed index fund, and then they followed it up by releasing a whole bunch of international fund and a few other funds. We'll link it in the video. But overall, I'm just really happy that competition is good for consumers, and over the past several years, the expense ratios have come down to bare minimum and even zero at this point. So Fidelity is probably running all of those zero expense fee funds at a big loss, but they're just trying to do this to get the consumers in the door, and that's amazing for us consumers. Now, how would I rank all of these different investment vehicles? Let's start from the bottom. So on rank 4, I would put an actively managed mutual fund, because Again, 90% of the actively managed mutual funds don't beat the corresponding index, and these are really expensive, and the expense ratios tend to be on the higher side. So now on third rank, I would place an actively managed ETFs. These are the newest in the category, and we still have to see how they really perform before you really commit to them. These are actively managed investments, and the expense ratios tend to be a little bit more lower compared to actively managed mutual funds, but they're still trying to beat the underlying index. Now, on the second place, I would place the traditional ETF, the traditional exchange traded fund, which follow a underlying index. Why didn't I put this in the first rank? Well, because ETFs can trade freely, and behavior is a really important part of finance. I don't want you to get in a bad behavior to try to short the ETF or try to leverage the ETF or try to time the market. And most ETFs don't allow you to set up a monthly automatic investment. Now, rank 1, I'm going to put a traditional passively managed index fund. These are extremely low cost options, and you're pretty much guaranteed to get 90th percentile performance pretty much all the time just by participating in the market rather than trying to stand apart and beat the market, which is extremely hard to do. And it just promotes good financial hygiene. And financial hygiene is extremely important. You can set up monthly payments and you can just automate your finances. It keeps you away from bad habits like trying to time the market, or again, you're trying to pick a certain target price. You can just keep putting money in every month and wait for it to compound and grow. The best way to benefit from compounding is never interrupt the compounding. Just automate the process every month, keep putting a set amount, and your portfolio will just blow up at some point. Now, does this mean that active management is completely dead? Do I personally use any actively managed mutual funds or maybe actively managed ETFs, or all I invest in is a traditional passively managed index funds? Well, I actually invest in all 4 of the above categories in different parts of my portfolio. And this is a little bit more of a complex topic, and I want you to watch my next video to know my views on this. So there are certain places in the market where active management still beats passive management pretty much consistently. Learn more in my next video. Now, if you're disciplined and you're going to try to avoid all the bad behavior, you're not somebody who's going to short the market and time the market, ETFs for that person could just be the rank 1 because they tend to be the lowest expense ratios, and they're also the most efficient way to invest in a taxable brokerage account. So scroll down below and comment what type of investment vehicle do you invest in. Please like, share, and subscribe my channel. Thank you for watching the Money Matters MD show. Over and out. The Money Matters MD show is for educational and entertainment purposes only. This is not financial, legal, tax, or medical advice. The opinions and views presented on this channel do not represent my employers or affiliates in any way.